Hello, and welcome to the Joss Brown Podcast. With over 40 years of combined financial planning experience, we will discuss our favorite topics, concepts, and stories.
Welcome today. This is Dan Joss with Philip Saunders here, Joss Brown Wealth Advisors, and we're going to be talking today about tax loss harvesting, which goes on a little series we're having with investments and the like. So it's not necessarily investments, but tax related. And if we have a lower tax bill, our investments are usually a little higher.
Yeah, I'm trying to think through that, but yeah, I'm sure. If Dan says it, I believe it. So
we pay less in taxes, our investments are a little higher. The money we keep is better.
Yeah, you keep your money. There you go.
Philip,
I'm there now. Yeah, I made it.
Oh, keeping my money. I like that one. All right. So what is tax loss harvesting?
So the basics would be selling a stock that's at a loss and then either waiting 30 days to buy it back or buying a different stock or security to replace that with.
Good. So we see a loss. We make an unrealized loss into a realized loss, which we harvest or keep that realized loss. What's the benefit of that?
Yeah, so the benefit would be taxes, as you said. So there's a couple of benefits. One is that if you already have realized gains in that account, then it offsets those gains. And so that's certainly helpful. If you don't have gains, you could use that loss on your tax return against your earned income, so your wages from work. And so the difference there would be if you sell a stock that's at a long-term capital gain, usually, well, always, those rates are lower. It's a lower tax than either short-term capital gain or your wages from work.
Right. So we can qualify that by saying current tax law has that long-term capital gains tax rate is less than the short-term capital tax rate.
Yep.
And it's also less than, depending on your tax bracket, ordinary income tax rate.
That's right.
Okay.
Yeah, and so what you're able to do is use a stock that may be long-term holding period to deduct against your ordinary income or your wages from work, which, as we said, is normally a higher tax rate than a long-term tax rate
but it's
would
not
be.
It's not a large benefit.
It's only $3,000.
Okay, $3,000. So
yeah.
If we are in some bad markets and equities are down, we, as advisors, look to see what the current market value is compared to the cost basis.
Correct.
And if we see that we have a position where we are underwater that's worth less than what we paid for it, we would realize that loss, which offsets all of the gains, or as much as we have losses for, offsets those gains.
Yep.
And then we could offset $3,000 of ordinary income and then keep all those extra if we have extra losses.
Yeah, that's
we can
right.
keep those for next year.
Yeah, unlimited
next year.
carry forward.
Okay.
That's right.
And I think that's per the individual, the taxpayer, not a couple.
Okay.
We would say consult with your
That's right.
tax preparer.
That's right.
Because those are the little rules that change periodically that have a big impact.
Yeah.
And so we do realize losses. We tax loss harvest those losses, keep those for reducing future tax bills.
Yeah.
Okay. Now you mentioned either staying out of the market for 30 days or buying something similar. Explain that.
Yeah. So the IRS says that you can't buy back that same security or what they call a substantially identical stock or security. And so they realize what people want to do. You want to sell that stock, realize the loss, and then if you still like that stock, just buy it right back the next day.
They said, all right, you can't do that.
Yeah,
we know what you're doing. You're trying to
that.
save on taxes.
Yeah, exactly.
Okay, so they've put in some rules
Yep.
that we have to play by.
Yep.
Okay.
So you have to wait at least 30 days for that.
Okay. So our firm, we would typically buy something that's still in the market, but substantially
Right.
different.
Correct.
Okay.
Yeah.
And again, this depends on the account and the goals of that. And what's interesting, because I have done this before, is you can sell a stock and realize a gain and then immediately buy it back.
Yeah.
Okay, why would someone
They
want
probably
to do that?
like that because then they're getting their tax money.
But if you're not in a big tax bracket and you expect to be in a bigger tax bracket later in life, then that advantages the client and disadvantages the IRS.
Yeah.
Right, but it's legal because arguably the IRS would want money sooner rather than later. So you're helping. It's a win-win.
That's right.
Okay. So,
Yeah, that's interesting. That doesn't come up often, but I'm sure it does. Yeah.
But we pay attention to where the taxpayer client is in their current bracket and what we think those brackets will be in the future.
That's right.
It's something we ask and answer every year. Should we do anything to reduce the tax bill?
That's tax planning.
And reducing the tax bill over the lifetime has different answers than reducing the tax bill this year.
Correct.
So that's kind of what we pay attention to. Because sometimes tax capital gains rates are zero and ordinary income rates are zero.
Yeah.
And there may be reasons, temporary reasons, why a client may be in a zero tax bracket or a 10 or 12% bracket, and they may not be in that in a year or 2 or 3 years from now.
Might just be taking a hiatus.
Yep.
Little sabbatical.
So whether
kind of
it's
thing.
realized gain or realized loss or Roth conversions, I mean, there's other things that we do throughout the year when we know a temporary situation has come up to a client that has changed their tax bracket for some period of time.
That's right.
Good. Well, what else? I've heard of wash sale rule. What is that?
Yeah, that's what we were talking about with the 30-day waiting period.
Okay.
So that's what they call a wash sale.
Okay.
Is when you sell that security and then the same day or next day or anytime within 30 days you buy it back.
So what actually happens with the wash sale rule?
So then
I mean, nothing says I can't do it, right? I could sell it.
That's right.
Think I realize a loss and buy it back. Then what happens?
Yeah, they would bring you back to your original cost basis, so you don't actually realize that loss and have it as a.
When you say they, who's they?
The IRS.
Almost.
The custodian.
Custodian, because they're the ones that are actually doing it.
Yeah.
And so we see that in our custodian's reports. It'll say disallowed loss. And we know that eventually it'll wash out.
But that's something you also have to consider as the taxpayer or as the tax preparer is, well, what if I have two different custodians? You know, that probably wouldn't come across, but.
You're right. And that's the tax preparer's problem.
Yeah.
And sometimes clients like to have different advisors, but we don't like to work that way. We want to see everything so that we know what we're doing affects the client and we're not being fought against or planned against by someone that we don't know.
And something else I was thinking about that you kind of taught me was it doesn't matter if it was a taxable account that you sold that stock in. You can't buy that same stock back in an IRA or a Roth IRA. In fact, the IRS says that in their literature. Yeah, that you can't do that.
Wasn't my rule.
Yeah, that's right. That's right.
Yeah, and so when we set up accounts, we like to know all the accounts. In fact, we'll give instructions to our custodians if there are other accounts that we're not aware of, so that they know what's going on also.
That's right.
And I guess there's two philosophies. One is I want to be diversified, so I'm not going to share information with different professionals. And the opposite is I want everything in one pot. Yeah. Good. What else we got?
Timeline?
What's that?
So something we do is not follow a timeline. A lot of advisors will wait until the end of the year to see if there's any losses to realize.
Yeah.
But we're continually checking throughout the year.
Because it's the calendar year.
That's right.
That's what
for the tax year.
That's what you report to the IRS. And so in December, it's like, oh, do we have any losses we could take and harvest?
It's kind of scrambling at the end of the year.
Yeah, we do that throughout the year. In fact, last year, so this would have been 2022, the low in the market was September, and then it went up from there. So if you had waited till December, you would have arguably missed out on some chances that happened 3 or 4 months earlier.
That's right.
Yeah, and so this is kind of a I guess unstated, but we'll state it. That's part of what continuously monitoring your portfolio entails, is doing things as opportunities come and not be limited to, we do that in July and we do that in December and, some arbitrary timeline.
Yeah, and that's why we meet regularly. You're able to discuss those things and look through them. Yep,
good. That's good. I think we explained what a tax loss harvest is.
I think so.
And the process around it. And now we know what we could harvest gains too when we want to.
There you go.
Well, that's a little primer on tax loss harvesting. We heard some words like wash sale rule and substantially identical stock or securities and some other technicalities. But if you think this applies to you, then talk with your advisor, talk with your tax preparer, and see how you can incorporate some of these things into you and your portfolios, and give us a call if you need help also.
Yeah.
Good?
Good.
See you next week.
See ya.